welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, and Robert Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Today's trivia theme is names. Except for in one case, I think we have initials. But anyway, close enough. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. We're also on television. Comcast Channel 26 and AT&T Channel 99 on Saturdays at noon and Sundays at 6 p.m. That is a mouthful. Today's special guest is Mike Zaidlin. We've had him on the show before. Welcome, Mike.
Thank you. It's great to be here, Edward.
Good. He is an investment advisor. Fine, right? Okay, now get this. Here's the question. Here's the point. He's going to discuss IRAs and 401ks too. Should you have one? Now, the obvious answer, we go, sure, of course you should have one.
Right.
Okay, so.
Not quite that simple.
Maybe not. Go ahead, take it away, Mike.
Well, that question really is part of a larger question of you probably, if you have a 401k, you should always try and get the match.
Sure.
Because that's
free money.
Only 100% investment return you're ever going to be guaranteed to get. But then the real question comes in of whether you should have an IRA or keep contributing to a 401k. That question comes in and really depends on many factors, probably the most important of which is what's your marginal tax rate at that time.
Okay.
If your marginal tax rate is really low, once you've got the match from a 401k, you're really not getting much benefit from contributing to an IRA or a 401k because you will end up being in an account that is tax deferred, that will be taxed without having given you the benefit of having deferred any tax up front. So when you're later on in life withdrawing and you're in a higher tax rate than when you were making the contribution, you're going to be hurt by that. The better alternative is probably, since you're not getting any benefit up front from the tax deferral of an IRA or 401k, is putting it into a Roth 401k if your 401k plan has one, or a Roth IRA. Or if for one reason or another you don't have a Roth 401k or something suitable like that, you are better off than putting it in a taxable account where you can at least get the benefit of investing in an equity fund, say, and getting a stepped-up basis and the benefit of capital gains and qualified dividends tax treatment. So it gets a little involved.
Yeah, because you don't get any capital gains benefit by having it in a retirement account. You lose it. Right. Basically, it's all ordinary income when it comes out.
Yeah. Absolutely, and of course, the other thing is when the money you're putting into a retirement account is money you, in theory, can't spend. So since I love to spend money,
well, we see a lot of people spending their IRA money, but then it's coming out with a penalty.
Exactly, and of course, if you really aren't getting a benefit from an IRA, of course, it should just go to a Roth IRA.
Right.
Or if you have young kids, a 529 plan, which is basically a Roth for college.
Okay, I didn't know that, and that's a great question because my wife and I are saving in a 529 for our kids' college, and I've heard various things about 529s and their efficiency in accomplishing that goal.
Yeah, I think I often see people coming in with UTMA accounts, which are trusts. But the problem is those are all taxable. They would have been, almost everyone would have been better off with a 529 if it's going to be used for college.
Well, it's like the HSAs. I mean, I love those health savings
the health
accounts.
Savings accounts,
Yeah, because it's like a big IRA.
Right.
Yeah.
So, Mike, are you saying that if someone's in a certain tax bracket, that it might not be a good idea at all, tax planning-wise, to, let's say, open up a Roth IRA account to maybe invest in alternative assets or real estate that could grow presumably rather quickly and large for your, to have tax-free in your retirement?
Yeah, I would say alternative investments, trust deeds, or even just owning real estate is definitely something that always has to be compared with all the other investment alternatives, depending on the type of account and other factors, marginal brackets and so forth.
So if we're talking about someone, I have an article I brought here. I didn't know if we were going to get to cover it, but I'm going to try and tie a couple of things here together. I work in home finance, so when people go to buy a house, especially first-time home buyers, which are a key segment of the real estate health, the real estate economy's health, If those individuals are in a lower tax bracket now, is it worthwhile for them to save to buy a home in lieu of contributing to a retirement that otherwise might be tax inefficient down the road?
I think it becomes a bit of a personal issue at a certain point. I think no one could really dispute that real estate is probably a better investment than stocks and bonds in general, regardless of whatever account you have them in. Real estate has multiple types of utilitarian value, tax breaks for the first $500,000 if you're married, so on. But mostly the utilitarian value of it, as well as its inherent inflation protection as an asset.
Okay, just for fun, because you weren't here.
Mark and I already like this guy.
Just for fun, before we went on air, I was showing Mike, I said, have you ever seen this chart? And this is it's a scary parallel between the stock market of today at the Dow Jones and that of 1929. It looks kind of similar, okay? And I'm going to show
audience, can you see that?
I'm going to show it to the TV audience here.
So describe to the radio audience exactly what you're showing.
Okay, this is a chart that basically looks fairly close for the period of 1928 to 1929 and compared to going from July 2012 to today. And it's pretty close, all right? And Mike, go ahead and tell us.
I have a feeling I'm being set up.
You are, but you know the answer because you entertained us.
Couple of guys sitting around the bar setting up the guests.
So, just the way the world works, there are always patterns that we think are patterns, but are really statistical randomness. But the human mind needs to see patterns to make sense of the world, just, psychologically. And as I was saying earlier, if you really wanted to, if you were going to act on that pattern, logically you would need to go and say, well, how many other patterns would there have been in the last 70 or 80 years that would have led me astray?
Yeah, sometimes it was the Super Bowl.
Good point.
Yeah, get this, okay? Drum roll, please. You're never going to guess this. Go ahead.
It turns out that the
Get ready.
The highest correlation to the performance of the Dow Jones is actually, of all the factors in the world that have ever been seen, is the annual production of butter in Bangladesh.
Oh, okay. I thought you were going to say
For how many years?
I think that's so. Well, how long has Bangladesh been a country? 1947, maybe.
Yeah.
So for 70 years.
It is.
So you want to track one index against the other.
Maybe because when you do a lot of butter, people become happy with all the fat and
I don't know.
invest.
Well, you're a betting man, Edward, so go for it.
Well, I mean, how does one find out what the production of Bangladesh butter is now?
How do you know to look for that stat? But one of the things I think is interesting about that is we look at charts, for example, the 10-year Treasury, the 30-year Fannie Mae coupons. We look at those all the time, and I watch these chartist guys draw lines on the trend.
Yeah.
How do you pick the top and bottom? They can draw a line between any of those and come up with a trend.
That's a good point, because I used to do technical analysis when I was younger, and it's very easy to look back and 20/20 hindsight and say, oh yeah, there it was. That is the hard part, is figuring out, oh, when did it go through the flag and
exactly
and inverted head and shoulders. I know all that stuff. Okay, tell you what, we're going to cut to a quick commercial break here. Again, the theme is names. What was the family name of Danny and his 3 daughters who appeared in the TV show Full House? Make sure to include your name and your email address. Speak slowly, spell out your email one letter at a time. Don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Robert Spinoza. When we cut to the first commercial break, we asked this trivia question. Again, the theme is names. What was the family name of Danny and his 3 daughters who appeared in the TV show Full House? Did anyone ever watch the show?
Huxtables.
No, that's the Cosbys.
Partridge.
No, that's the Partridge Family.
No.
The Cleavers?
No, but oh my gosh. Okay, no, Tanner.
Yeah.
I know we're all.
My daughter would have known that. She loves watching those old.
My wife would have known that.
Okay,
Yeah.
there we go. We're also in the studio here with Mike Zaidlin, who's an investment advisor, who's been teaching us how to predict the stock market with Bangladesh butter. If you missed the first segment,
It actually has multiple uses.
is production of Bangladesh butter apparently a fairly accurate predictor of the Dow.
So far.
Wow.
So we'll see that. Of course, when everybody starts following it, then it'll change.
cease.
So you got to be shh. supposed to be a secret.
Don't tell the hedge funds.
Yeah, exactly. That's right. So, Mike, I was going to give you a little plug here because one of the nice things about working with Mike as an investment advisor, he doesn't charge a commission, but he also doesn't charge a percentage of assets, which a lot of guys do, so that he's doing a little bit more of the, charging either by the hour or by the job.
A la carte, sort of.
Basically,
Yeah,
right?
yeah.
So, Mike, we're going to move on. So, I want people to give you a
Oh, I
call.
thought we were just getting started.
I'm sorry. No, don't worry. You can still pipe in for all this other fun stuff because you're an intelligent guy.
Yeah.
How do people get a hold of you if they want to buy some Bangladesh butter? No, I was kidding. Okay, hey guys, you know what? We received a couple of really interesting emails. I want to just get right into this here. For Mark, are the new restrictions on loans helping or hurting your business? Am I better off investing with you now, or should I have before the changes? little 2020 hindsight.
Yeah, a little late if you haven't invested yet. So, so our company, Pacific Private Money, we have a mortgage pool fund that we use to make loans to real estate investors. And we've made over 600 loans to real estate investors since 2009. And these are usually short-term loans at relatively high interest rates to rehabbers and contractors and other real estate investors who are buying, fixing, and flipping real estate. And that's still going on. It's been going on for the last 3 or 4 years, hot and heavy. And notwithstanding what you might read in other real estate articles, there are still plenty of people out there who are finding opportunities to buy a property, add value by remodeling it and putting it back on the market and selling it for a profit. Now, the banks don't make loans to guys like that for a couple of reasons. One, a lot of these guys don't have the greatest credit in the world because a lot of them were real estate investors when the market turned, and they may have a foreclosure or short sale on their record. But also, generally speaking, in today's market, since it is fairly tight to find good deals, you usually have to be aggressive in the offer. And so you make a very fast, aggressive offer,
Right.
Low or no contingency, no loan contingency. Usually they're making an all-cash offer with a quick close in 2 weeks. Now, banks are not able to generally accommodate that kind of quick close financing, and so it's been a really, really strong market for the private lending market. We used to call ourselves the hard money lenders, but most of us nowadays prefer the term private lender, hence the name of my company, Pacific Private Money. So we make privately funded loans to these real estate investors, and we're charging them anywhere from 9 to 11% because they're only using the money for anywhere from 6 months to a year. And what's really great about that type of loan product is that it presents an opportunity for private individuals like yourselves out there in the listening audience to participate in those high yields because we use private individual capital for that money. We're not a bank, but we make bank-type loans, bank-like loans. The loans that we make are really no different than the banks make. Other than the rates and the fees are higher, but the paperwork we use, the legal basis for them, the note, the deed of trust, they're all pretty much identical, and they all go through escrow companies like a bank would. So that's a little bit of the backdrop. So the question was, has the recent changes, which have really been restrictions on lending, have they affected our business positively or negatively? And well, I don't want to say the jury is still out, but by and large, if anything, I'm guessing it's actually going to help us out, because if to the extent that people are less able to borrow from a bank, presumably they might be more able to borrow privately, assuming that they can live with the type of rates and fees. Now, probably the more correct answer is it really doesn't have a whole lot of effect. And the answer, the reason why, is because banks generally make loans to consumers, and companies like Pacific Private Money, we make loans to real estate investors.
Right.
And never the twain shall meet, right? So
Okay, but is your business more correlated with the production of butter in Bangladesh?
That,
like the Dow.
That I am not sure. I'm going to have to go check that chart and make sure it against private. Now, private lending has exploded as an industry since 2009. Since the mortgage meltdown.
It's not the best kept secret anymore.
It's one of the better kept secrets in how you can earn a better yield on your savings than you can generally find at the bank or through CDs or bonds. The stock market, well, the jury's out on that too, because if you didn't get in,
Right.
over a year ago, you're not enjoying the fact that it's up 25% year over year, but you're kind of going, is now a good time to get in? So if you're a little bit concerned about what might happen with stock prices this year, and you're looking to maybe hedge that with some alternative investment strategies to boost your yield, you might want to consider taking a look at our mortgage pool fund product. We call it the Pacific Private Money Fund, and you can find more information by going to our website, which is called, surprisingly, pacificmoneyfund.com.
If you're an investor out there and you're thinking about an investment, and maybe you look at private money and getting into real estate and you think, gee, this is risky. Well, let me tell you a little bit about the light at the end of the tunnel. And it's putting a house on a market like we have right now in the Bay Area, where there's very low inventory, and you are putting a turnkey residence back on the market that people are going to clamor over. And I'm seeing a ton of that out there, but you've got to have the ability to get into those properties when they're not in that condition, rehab them, and take the risks inherent in that, but possibly on the investment side, you have the option of benefiting from that as well.
Absolutely.
Yeah.
I have a question, Mark. What are the general loan to values of the properties in the fund?
Well, and thank you for asking, because that's the thing I did not say, is that we actually lend very conservatively. So we generally don't go higher than 70% loan to purchase price for the loans that we make to the real estate investors. So we tend to work with real estate investors that are well capitalized or have their own source of equity, because we don't do 100% financing.
Right.
We're not out there making risky loans. And of course, banks will make loans at 80% and higher. Frequently for consumer home loans, we make loans on investment property, usually capped at 70% of the purchase price. So not only that, the buyers are improving the properties. By the time they put them on the market, our LTV exposure, our loan to value exposure, is usually below 50%.
Yeah.
So we're very well secured and, in my opinion, fairly conservative for the type of yield you can get, which our fund right now is paying about 8.5% interest on an annual basis to our shareholders.
Okay. Before we get to Robert here, I do want to give and I promised this lady I would do this, a special recognition to a lady named Holly Nichols of American Cupcake on Union Street in San Francisco. Let me tell you what happened. My daughter accidentally left her purse there. And this lady's the manager, and she had found it and then put it like underneath the counter, right? Then somebody had decided to move it to the back office. Still, there was no lock. There's no place to lock it up, right? So my daughter, she finds out that her purse is there, right? So she goes there. Turns out the purse is gone, and it's like, oh my gosh, what do we do, right? So this lady has the integrity and honesty to say, we'll make a list of stuff, the cost of the purse plus the what you honestly believe was in the purse, and we will reimburse you.
Wow.
I mean, and
I
was on the phone. I said, "Are you serious?" And sure enough, Sarah was very honest. She listed everything. Went back there, and it was like $300 because she had some cash. She had some, and forget the time value of having to go to the DMV. No one can reimburse you for that. They literally gave her $300 cash.
Wow,
isn't that amazing? So
what's the name of the place again?
It's called American Cupcake on Union Street in San Francisco. Ask for Holly Nichols. It's nice to know that humanity has got some good stuff.
Good for you. Yeah.
Good. Okay. Well, tell you what, Robert. We do have to cut to a commercial break. So when we come back, Robert, we have a very interesting question for Robert here. Again, our trivia theme is names. Call 888-912-1190. That's 888-912-1190, to answer this question. What was the nickname of Charles Luciano, who is considered the founder of modern organized crime in America? Don't touch that dial. The Best of Investing. We'll be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff, president of Pacific Private Money, and Robert Spinoza of RPM Mortgage. Here's the trivia question. What was the nickname of Charles Luciano, who is considered the founder of modern organized crime in America? Anybody?
Bugsy.
No. Lucky. That is correct. Lucky Luciano. Bugsy. Give me a break. Okay, so now we're finally at Robert Spinoza, and here's an email we have for you. Is it possible to put down less than 20% and still get a jumbo loan? I'd like to buy something in the Bay Area, but don't quite have 20% saved up yet.
Good question. Yeah, it comes up all the time. One of the most common questions I get. And the answer is yes, you can do that. Now, there's a few things you've got to keep in mind. It highly depends on the purchase price. And when you talk about putting less than 20% down, it also depends on whether you're putting 5, 10, 15, whatever it may be. Let's use an example. Median home prices here in Marin are crazy. But let's look at a common scenario in, let's say, Silicon Valley, here in Marin County, San Francisco even, $1.5 million purchase price. Okay, if you're bringing 20% down, you're bringing $300,000 to the table in down payment. If you're a buyer and you don't have that, let's say you have 10%, RPM will still make a loan that will accommodate that. What we'll do on that is we'll use a program that has come back. It existed before the downturn, but it's back now. It's known as an equity share. And the way it works is the equity share agreement will match the down payment of the buyer. So the buyer's going to bring in this case, $150,000, and the equity share will match that. It's
Then
not
80-10-10?
correct,
Okay.
but it's not a loan. So in these scenarios where you're going to 10% down at 1.5 million or something like that, what will happen is you will take this equity share, and then when you sell the house, the equity share company will capture a percentage of the appreciation. So you don't have any payments while you hold the loan. It's not a loan again, but you don't have any payments while you have the equity share arrangement.
Okay,
in
so
place.
they're a partner, basically.
Yeah,
And is it RPM that's actually doing this?
Our
or-
RPM is not the equity share
okay,
company.
you just
RPM
arrange it.
RPM will make the first mortgage loan.
Yeah.
So, and it's important that the first mortgage lender will permit that, of course.
Yeah.
So we have a program that'll do that. And the reason that is gaining traction here in a lot of these areas is because when you look at jumbo qualifying, you've got to remember that not only do you have the down payment requirement, you also have to have reserves post-closing. So
Sure.
if you took all, and reserves are defined as your monthly mortgage payment times any number of months. And
Yeah, they're going to make sure that qualifying repayment.
right, and if some hardship were to befall the borrower, then they would have reserves to make that payment conceivably. So that's what's happening there. And so even if you had the $300,000 to put down in our example, you might not want to do that. Or if you did, you might fall short on reserves to buy in that range. So what the equity share is allowing people to do is not only put down less money, but also buy into a range that potentially could appreciate at a higher clip and may get them into a house that they really want to be in and in a neighborhood they want to be in. So
How long
it's-
has that been around? This arrangement?
Good question on that. I know it started before the downturn, so it probably began in, I would say, 2003, 2004, and then, completely went away during 8, 9, 10.
Sure.
But now we're seeing it back, and we're seeing people begin to make sense of it, because obviously, when you're thinking about conceding a portion of your appreciation, that ties directly into the investment of it being, the real estate investment itself. But you've got to look at it the alternative of what if you don't buy the house? What if you buy in a lower price range? What if you're servicing debt? So the short answer to the borrower or to the caller's question is yes, you can do it. There are also more traditional ways to put down 10% if the purchase price is a little bit lower.
And again, what's the term generally for that? Meaning, like, is it a 5-year deal? A 10-year
No,
deal?
it's a 30. The company, the equity share company, is getting long-term money. So endowments, things like that, and
I was gonna say,
they're
it's a zero coupon bond, basically.
yeah, they're exposed for up to 30 years.
Man.
Yeah,
Wow.
but remember,
amazing.
they're looking at a percentage of that appreciation. So yeah, their capital is tied up, but
Yeah.
the longer it goes, conceivably.
Gosh,
the
I
more
mean,
it
because a
makes.
zero coupon bond, like for treasuries, you can sell. I mean, this is going to be kind of a hard sell for them on the secondary market.
Well, there's a lot of you can look a lot into that, but believe me, they've looked a lot into
Okay,
making those.
so remind me 25 years from now to start looking, and with only 5 years to go, I'll see what kind of discount they're willing to take.
So yeah, that's the way it works, and you can do 10% down, and I'm happy to help if you have questions about that. We also, like I said, do the traditional 80-10-10 sort of situation with the home equity line of credit.
You have any questions for Robert?
No, listening avidly here.
Okay. No, he's very
Learned
good.
a lot.
Yeah, a lot of people in the Bay Area are in this situation, believe it or not, and you talk about those purchase price ranges, and people across the country are like, but it is our reality here. When you talk about our median home price, it doesn't fit into the conventional box on lending for a lot of folks.
Robert, what do you think is going to happen as we see less, first of all, the refi boom's pretty much gone.
Yeah.
So, there's a lot of speculation about what banks might do in the coming months or even the coming years in terms of coming back on the market with more creative financing. to
We
entice
are,
more.
great question, Mark. We are, right now, we are looking at a number of programs that will help the self-employed borrower. borrowers.
Oh, that's
yeah,
important.
very
Yeah.
important.
Yeah.
And if any of you are in that situation and you have questions about it, get in touch. It's something that will be coming shortly, and we'll have more detail about it. But also, make sense deals, because now you've got the very, very stark line between qualified mortgage and non-qualified, and lenders that are going to be playing in non-qualified mortgage space are interested in finding ways to accommodate the borrowers that have been shut out.
Nice.
So yeah, I'm optimistic about that, and I think we're going to see more exciting product come back. It'll make sense, and the pricing will be good, but it won't be stated income, and it won't be the Wild West that it was.
And also, if people are interested in getting a hold of Robert Spinoza, they can also go to the Best of
Best of
Investing
Investing.
website. Okay, I'm going to cut to another quick commercial break, and when we come back, I know we've got some interesting articles that you have, and I got ones that you are not going to believe. They're going to crack you up and make you angry at the same time.
Better than butter.
Better than the Bangladesh butter. That's true. Now, every time I think of Bangladesh butter, I'm going to think of you, Mike. Okay. Silence. Okay. Here is the third and final trivia question. Which U.S. television network is known for its peacock? Don't touch that dial. The Best of Investing is going to be coming right back with some very interesting and upsetting but funny articles.
Cool.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Robert Spinoza. When we cut to the third and final commercial break, we ask this trivia question. Which U.S. television network is known for its peacock? People?
NBC.
NBC, that is correct. We figured we'd throw one easy one in there.
Yeah, well.
Okay, I promised the audience when we came back we were going to get into some article that's going to make you laugh and be upset at the same time. So here is this article I read. Mass killer unhappy with prison because he wants better video games. He even says here, "You're killing me. You're giving me kids games rather than I need a PlayStation 4 instead of a PlayStation 3."
I got two words for him: Joe Arpaio. You know, it's the guy in Arizona that feeds everyone bologna sandwiches and waits to wear pink underwear. Have you heard of this guy? He is I believe he's the sheriff.
Oh yeah.
Yeah, in Arizona. And basically he's taken away all the perks. He's like, you guys are in here for a reason, and it's not a good one, and you're going to toe my line. And every time I read an article by him, I chuckle, because I think, look, I have varied feelings about all of this stuff. I don't agree with the perk thing, but the whole prison thing is a different story.
Well, he says he's being tortured.
Well,
now this guy is serving a renewable 21-year sentence for the deaths of 77 people in a bombing and a shooting rampage, and he says that he's going to go on a starvation hunger strike.
Yeah.
And I say, let him.
At it.
We should all be so lucky to lose weight like that. Okay, so then one other quick thing I want to bring up, and then I want you guys to take it away. I saw an article about a city in Marin, which will go unnamed.
Okay.
And now here, they're requiring its city manager to start putting in for her own retirement. Okay, so that's good, right?
Right.
Pension reform. However, the city council gave her a raise to compensate. So let me tell you why that's actually worse, because what happens is when she gets a raise, then by the time the retirement, it's based on a higher amount. It would have been better to just not do anything.
Right.
So it's like, where's the pension reform if you give someone a raise to compensate for the fact that they have to put the money in?
Yeah, there were more than a few letters to the editor about that in this week's Marin Independent Journal, I must say. Yes, just another sad attempt to try to address the problem by not addressing it or making it worse.
Making it worse, exactly. Okay, articles, guys.
Geez, Robert brought in like 4, 5, or 6 articles.
Well, I
real estate for this week.
try to
Oh my
come
gosh.
prepared so that we've got some cool stuff to cover. But yeah,
Well, let's start with a scary one
Yeah.
here. I like this one here. So Dan Walters of the Fresno Bee had an article titled "The Dark Side to California Mortgage Relief," and I was not aware of this. Now, of course, those of you who have, I'm not going to accuse the audience of having had foreclosures or short sales, but those people in California who lost their home either to foreclosure or sold their home via short sale,
right,
where the bank essentially took less. We all have heard about this situation where there's a taxable event when you get a relief of debt. So if you owed $1 million on your home and it sold for $800,000, there was $200,000 in debt relief, and that's considered taxable. Now the federal government, every year since I guess this started to happen, 2008, 2009, has exempted
relief,
that,
yeah.
has given taxpayers a relief from that being taxable. Apparently, that is not so the case in California for 2013.
Yeah, so it looks like there's a bill held up in Congress that would have otherwise extended the relief.
that,
Right,
yeah.
but because it's held up now, as we cross the tax filing threshold, some of these individuals may be impacted.
Well, are they
by
going to
that.
make it retroactive?
Good
in
question. I don't know.
California?
It doesn't cover it in the scope of that article. but-
So potentially, we might have a situation where federal, it might be relief,
But
but
you-
California, you have to pay taxes. That's
Or
possible.
California-
Yeah, that's possible.
That's
But you know the tax side of things better than I do. But this is it. I mean, this is a kick them when they're down sort of situation,
Yeah.
isn't it? And unless they've recovered their financial situation and now are like, let's say they bought a new home or something like that. How do they collect on something of this nature? I mean, if you got hit with a tax bill of $200K and you foreclosed 3 years ago or something like that, how are you coming up with $200K?
Yeah, apparently this is there's
You mean the
9
tax on
billion.
it.
Yeah, right.
Apparently, there's $9 billion in estimated debt relief just in the state of California.
Just write a
alone.
check. You don't have money in the account, just write a check.
You know,
Well,
I will tell you though, you do not want to owe the state of California or any of its state agencies any money. They are
They're
among
ruthless.
the toughest, and my God, it's just they're nasty to deal with.
So what do they? So what will they ultimately do? Will they garnish your wages and things like
Sure.
that? Okay.
All of the above.
Yeah.
Oh my gosh.
It's
yeah.
it's a regular debt like everything else.
Right.
It's just like you won a lot of, you just made a lot of money. Effectively, you made a lot of money.
So another political football. We'll see what happens. Whether or not our folks in Sacramento do again extend that relief, or if we start reading articles about people getting very nasty tax bills.
Yeah,
in
that
the
would be
mail.
quite an unpleasant surprise. One of the other things I've got here, it's sort of on the other end of the spectrum, and I believe we've covered this on the show before, but it's about student debt and how, over the last few years or decade, whatever you want to call it, students have taken on an untold amount of debt, and now as they enter the workforce and hopefully enter the housing economy, this student debt affects their ability to get a loan. So first-time buyers have customarily contributed to a big segment of the home buying population, and with laws or regulations regarding mortgages more stringent than they were, you've now got a situation where some of these folks are not going to qualify because their loans are either not deferred for a long enough period of time, or their payments on the existing loans are such that it's impacting their debt ratio. Because remember, one of the key components of qualifying for a loan now is the ability to repay provision. And so lenders are, in some cases, held to a very strict debt-to-income ratio. They don't have an allowance to go above and beyond that. And when you've got student loans there, they're not going away either. So you're in a really tight situation. You obviously want these individuals to come into the real estate economy, because that has a lot of implications down the road that are beneficial. But
Absolutely.
yeah, I mean, if you take them offline because they're saddled with student loan debt, so it's something I see the industry talking more about, and they're looking at it. But yet, on the other hand, you have the FHA saying they may tighten up the guidelines for deferment. Typically, if you have an FHA loan and you've got the deferral on the payment of your student loan that goes beyond a year, they're not going to count that. But now, if that goes away, obviously they will. So they'll need to get a payment number on that loan.
So that's an interesting twist to a statistic I heard about at a real estate conference that I went to that talked about some of the reasons why this particular speaker believed the real estate market would actually be very strong in 2014. And one of the reasons he cited was these these people between 20 and 30 who live at home with their parents, who are now looking at, okay, it's
Right.
time to go out and move out. Well, that might be offset a little bit because a lot of those folks do have student loans.
Yeah, I
So
think
that is an issue with their DTI ratio.
their debt to income ratio, right. I think what Mike was saying is really fascinating too, because when I think that there's going to be a shift in the way people think about all this now as the most recent recession gets behind us. We have to assume that a generation's thinking will be changed by that. And so the generations before that influenced a lot of us, they're the younger generation, they're going to see things through a new lens. And I think that the student loan debt, and I think that thinking through retirement and purchasing real estate are all components of that, and we've not yet realized exactly what their mentality will be, nor has the housing economy that we see. I think what we see right now is still, here in the Bay Area, you've got high-tech people that have done well. They studied in the field that they're working in now. They work for a fast-moving high-tech company. They've got the money to spend on a piece of property, and they want to be in a certain area. So they'll make that leap. But that's not across the country. That's not everywhere. And I think these stats reflect a nation as a whole, not just the California Bay Area.
Absolutely. Another interesting article, Robert, you brought in here that I thought was noteworthy. We talked a little bit earlier about that when I was talking about the type of loans that
Right.
we make and why private money lending has been on the rise, because it's you can, as a buyer of real estate, you can go in and make basically a no frills offer, a quick close offer, and use private money to close that. Here's an article that was in the Wall Street Journal titled "The Alchemy Behind a Winning Bid."
Yeah.
To the Wall Street Journal, they use the word alchemy in it. Alchemy behind a winning bid. They're so stuffy over there. So here's the. It talked about how to basically homes that had the successful bid. What it doesn't say is in this particular article is how many homes that they surveyed, but let's assume there were a lot. So all cash was the winning bid in 31% of the offers. Pre-inspection, 71%, waived financing contingency.
So you go in and say, I, no matter what happens, if I'm getting a loan or I'm not getting a loan at all,
Right.
I'm good
Right.
for the
Waived
dough.
financing contingency was 63%. That's
Yeah.
a huge
See,
number.
I got to figure that some of the sellers are realizing, it's kind of getting difficult nowadays.
Yeah,
for
yeah.
people
Your
to
sellers
get-
don't want to deal with the loan,
Yeah,
right?
they just
yeah.
say, what are the odds this guy's going to get a loan?
Right.
You know what? If all cash, out
Right.
there.
Or just not necessarily all cash, but just no financing contingency. Now here was the largest percentage, which surprises me. They waived the inspection contingency. 74%
Wow.
waived the inspection
Well,
contingency.
it sounds like a frenzy, really.
Yeah, that's,
Well, and
that's a little scary.
And
to
my
me.
comment off the air with Robert was that because I make a lot of loans to contractors and rehabbers who are borrowing money from me to buy a house that they want to remodel and flip, I know that a lot of those guys, they're good, but when you do substantial remodel, there's stuff that oftentimes
Right.
needs to be taken care of, and so you're waiving the inspection contingency. What that basically means is, I don't see anything in the house that I want you to change before I'll buy it. Well, then you move in and it's like this doesn't work, that doesn't
Right.
work. It's
Settling.
Well,
Yeah.
hopefully
Yeah.
the contractor's gone through the house enough to
Well,
do
one
his
thing-
own little inspection. right?
One ad I want to have on that article is I think a lot of home buyers out there now, because of the frenzy, have been discouraged, and I think, I keep getting beat by all cash offers. I say keep your wits about you, and even if you're getting financing, have at it and keep making offers if you like the property, because all cash is 31%. So if you don't know if that all cash offer is lower than the offer you're making with financing. And a lot of us in the lending industry, look, one of the best compliments I can get from a real estate agent or amongst real estate agents is he's good as cash.
There you
Meaning
go.
that, this guy's going to perform, he's going to get the loan done for you. And if you're working with a lender like that, you may find that you have an edge over all cash.
Great. Thanks,
Awesome.
guys, for being with us yet again. Here's our thoughts for the day. Mark Twain said, "When your friends begin to flatter you on how young you look, it's a sure sign you're getting older." And Mae West said, "Save your boyfriend for a rainy day, and another in case it doesn't rain." And
She
Mae
had some
West,
great lines.
She definitely did. They're her and W.C. Fields. Tune in next week to the Best of Investing. We're going to be giving away how many? 9 more free vacations for answering trivia questions. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Welcome. You're listening to the Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, and Catherine Harris, CPA of Parati & Karad. Today's trivia theme is, for all you math whizzes out there, right triangles.
Ooh,
This is going to be a fun one.
this is back to like 5th grade math.
Yeah, well,
Oh.
probably a little bit more than that, but along those lines. Yeah, they're not too hard, but you got to think a little bit. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And Mr. Kramer here is videoing us for television, Comcast Channel 26 and AT&T Channel 99 on Saturdays at noon and Sundays at 6 p.m. Today's special guest is Rob Goldstein, who's going to discuss avoiding scams and how not to be taken advantage of. Rob, welcome to the Best of Investing.
Well, thank you for having me back.
Yeah, we brought you back here. Okay, so I'm going to just get first right into this here. What's the most popular scam consumers run into, and how do we avoid them?
Well, there's so many, really. I don't know which one's the most popular. But the first thing is that everybody eventually is going to be hacked into with identity theft on their debit cards or credit cards.
Sure.
So be careful about giving out your credit card information online or giving it out to people, because they take the credit cards and they sell it on the open market.
Okay, but obviously, I think almost everybody buys something online. You know, Walmart or Target or, well, of course, Target, that's not a good one now.
Yeah.
Well, Amazon,
Amazon,
Zappos, just to name my two favorites. But how do you minimize exposure to scam?
Well, I think the first thing you should do is keep a separate credit card or debit card with a very low balance. I like using a debit card. And I like having a small balance in there enough to use whatever you're going to be using it for, and then replenish it.
You talking about the credit limit?
Huh?
You're talking about the credit limit?
Or having a separate bank account.
Yeah, the credit limit. So
Credit
you use
limit.
$1,000 on a debit card, and as you use it, replenish it, because if it does get stolen, then we can't spend that much. And most cards, of course, will call you when they see some strange spending. But if you have low limits on there and you can keep them at the low limits, then you can limit also the amount that you can lose if you get hacked.
Okay, so wait a minute. So, Rob, I guess for a credit card, you could have a low limit there, but on a debit card, that's where you're talking about replenishing it, right?
Yeah, you can keep $1,000 in that account and then replenish it as you go along.
Oh, that's an interesting idea.
Because everybody will get hacked.
I know. I was a victim of identity theft, so I know it.
I actually got hacked from a very, very credible hotel.
Oh, really?
Did you figure out how it happened? Was
Well,
it like a maid?
somebody at the front desk, and they took the information, they sold it to their buddies, or they gave it to their buddies. And then when I did get hacked and it was reported to the police, they found it, and they found out where it came from. There was a hotel that I've been going to for 30 years. 30 years.
And a lot of times they sell this stuff for like $50, don't they?
Yes.
God, they could ruin your life for $50.
They can. And well, I guess the major point to bring to this is where you have your looking at your credit reports, either on a monthly or on an annual basis. You can get it for free, or you can also sign up and get monitoring through the 3 major credit bureaus.
Well, those monitoring services can be quite costly, but you should get your own credit reports, and we suggest getting credit reports from companies that offer you a free report but don't charge you for the services. If those companies offering free credit reports, those come with when you sign up for the service, that could be as much as $1,000 a year.
But you're allowed to go once a year for free on each of the major ones, right?
So then again?
You're allowed to go for free to get a free credit report once a year from
Yeah,
Experian.
you can do that. They're getting so much easier to get now. You can get them once a year from each agency. You can go to places like undercreditreport.com and really get a free credit report without having to sign up for services. But some of the leading brands of credit reporting services that offer free reports that you see on the radio and TV, be careful. They're selling you services. You get free reports. You spend about $1,000 a year.
Oh my gosh.
Oh, wow. I didn't
Yeah.
know the monthly fee was that high.
Everything, unfortunately, in hard times, everybody's coming up with more gimmicks and more scams. And so just assume that lots of them are scams, and be careful out there.
And their websites sound very similar to the free ones.
Yes.
Yeah, I remember that. You also have here some information about 3 things that you need to do before considering bankruptcy. I know we're shifting gears, but I wanted you to talk a little bit about that if you could.
Well, I offer bankruptcy consulting, and in my book, Taking Charge of Your Credit and Debt, we talk about the bankruptcy a little bit, and most people can't file bankruptcy if they have too much income or too many assets. So some people need to understand the options that are available to them. But what I like to do is to help consumers avoid paying creditors from the bullying tactics. Creditors will call you and hustle money out of you today by phone, and they create an urgency like the world's going to blow up if you don't give them money by phone today. And you as a debtor, the person owing the money, you have your rights under the Fair Debt Collection Practices Act not to get hooked into all those schemes. And there's a lot of people that are claiming that they are the creditor, and they're really not the creditor. And what you should do when somebody calls you for money is the first thing you want to do is validate the debt. Ask them to send you in writing by mail
Fair enough.
information about the debt that they're the rightful owners of the debt and that you actually owe that debt.
Yeah, don't you love when you hear about someone posing as the IRS and they say, well, don't write the check out to the IRS, write it out to Joe Blow, and don't worry, we'll take care of your tax plan.
But a lot of those creditors
I have
are
a
very
client- I have a
vicious.
client
They bend those rules.
From the same scam twice, and it was a company saying that they were their mortgage company, and they give them $15,000 now to call the past dues credit. She not only fell for it once, she fell for it twice, and spent about $25,000 paying the wrong party to get her mortgage current.
So in that case, okay, I guess what you do is you'd call your banker, and if you don't have a banker, you should initiate the call to the bank, right?
Say that again?
You should initiate the call to the bank rather than receiving a
So the
call.
banks are going to be calling you for a question. I mean, you're a day late, they're calling you. It's just, that's the way the question goes these days. But you should always find out who you're talking to, and get the information, and then call the bank back up and verify that all.
Yeah, I got to tell you that I had a situation where I got a call from my mortgage company, large bank, and the guy says, your loan is going to be coming due pretty soon with regard to changing the interest rate. We can get you into this good rate, such and such, and it sure sounded good, and it was good. It's funny because I went to my regular banker, and the guy says, well, make sure the guy really works for our bank,
How funny.
And I actually go, oh my gosh, that's right. He might be a scam artist, and even though he sent me stuff that looked appropriate, and the email and letterhead and all that stuff, and unfortunately, it was accurate.
Well, on that point about fraud,
I live by coast. I live in California and New York. And there's an attorney in New York that was disbarred and closed down for getting money out of people. And the mortgage, he was actually a foreclosure attorney for the banks. And the state shut him down, and he ripped off about $80 million from the banks and the consumers.
Wow.
There are law firms out there posing, trying to collect money, and they get the money, and they don't give it to the creditors either. So, they're out there. Everybody's out there scamming somebody. And I guess you should always do things in writing. When you make a settlement, you make a deal, do it in writing first. And I will tell you this: if you give a law firm payment for your debt or settlement on your debt, and they represent and validate that they don't have the rightful owner of that debt, then at least you have something to go back on should sell your money.
No, that's good advice. Catherine was going to say something here.
I was just saying you have to be conscious wherever you go. There's people who work or have a relationship with a viable bank or work with various government agencies or work with other companies who are legitimate, and they can give you very legitimate information. I imagine, Rob, you've heard some crazy stories of how fraudsters can do it. They are very, very creative, and they can get corporate signatures by. I've actually seen a fraud case where they were leasing I think mortgages or other vehicles, and they had to get a corporate someone to sign off on the corporate. They used to work with the company and they left, and to get around it, they called the secretary who was the corporate secretary who was on there, who was working. Who didn't know them.
Didn't know them.
They
Okay.
pretended to be radio show hosts. And she won a contest, but she won a contest, and she won a free stay in New York for $3,000. She just needed to sign the release form, to get her prize.
sure.
She was very happy to sign a release form, and they were happy to shovel over $3,000 for her signature that they then were able to forge and get it.
Oh, wow.
I don't know.
So they even gave her the $3,000.
Oh yeah, well,
They
it was a
wanted to-
huge fraud. I mean, it was millions of dollars. I can't remember. Was that down in Florida?
It's funny. Some of these guys, they don't even pay the $3,000. They try,
Yeah. So at least she made good. At least she got her free trip to New
That's
York.
great. That's
Well,
great.
Rob, I tell you, we're cutting a little bit short on time here, but you've written a book about this kind of advice, haven't you?
Yes, it's called Taking Charge of Your Debt and Credit.
Okay.
And it's available on Amazon, it's available online. You can always call me to get a copy of the book. Whatever they want to do, and offer information. I can help people make their own choices and explore their options.
Okay. And when you go on Amazon, make sure you use one of those debit cards that you were just talking about with a limit, specific limit.
I think good on it, that's probably pretty safe.
Great. Rob Goldstein, thank you very much for sharing your wisdom with us.
You guys have a nice night.
Thank you, too.
Right.
See, he said night because he's back east.
He's 3 years
Ah.
ahead.
He's back east. Okay, we are going to cut to our first commercial break, and again, the theme is right triangle. We're gonna see how smart you people are here. You got to think about this for a little bit. Okay, a right triangle ABC is given where angle B equals 90 degrees. Which side of the triangle is the longest? AB, BC, or CA? Don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Catherine Harris, CPA. I always have to say CPA after that.
Yes,
So
you do.
That's right, so the audience kind of perks up. It's like
She's
saying,
lettered.
doctors. Yeah, exactly. Speaking of letters, our trivia theme is right triangles. And here's the first trivia question. A right triangle ABC is given where angle B equals 90 degrees. Which side of the triangle is the longest? You had a choice, AB, BC, or CA. Now, Mark took off his shoes and socks to figure this one out. And what did he come up with?
AC.
AC, air conditioning, or CA, California. That is correct. Catherine, you have an interesting article.
I do. I guess it's more of just of an open-ended conversation that I feel like I have to have because it's something that's been kind of boiling up inside of me over the last kind of 18 months, and as things kind of progress. It's really the discussion around Facebook's proposed, I don't think it's actually finalized,
Okay.
acquisition of WhatsApp.
WhatsApp with that WhatsApp
Oh, WhatsApp.
transaction.
Okay, that's
WhatsApp.
basically it's a text application.
It's a text application which has no advertisements, which I, again,
Okay.
find completely contradictory to what Facebook's revenue is
you know what?
derived from.
They'll probably include it. I had downloaded WhatsApp. My son told me to do it because when we were out of the country, apparently you could text with. It was free. It was like Skype.
Yes,
free.
it definitely outside of the U.S. it's amazing though.
Yeah.
It's worth it. But go on.
Okay. Well, so no, I was just going to say that maybe what Facebook's going to do, they buy it and then suddenly they start throwing on, just like some of these great websites that you use a lot, and then suddenly they say, okay, from now on it's going to cost $100 a year to use it or something.
Yes, like a lot of the news are. Wall Street Journal, I think, now
Okay,
has it where if you
yeah.
have it. But it's just that I feel like we're being bombarded with advertisement. And even when I look at my emails, now they're even in the threads. I have 3
Oh, yeah,
emails and then there's an
yeah.
advertisement.
Or games.
Yeah.
It drives me crazy. I'm playing solitaire and I'll up Donkey Kong or some kind of crazy thing.
I don't know about you guys. I love tech, but we're of an age where we kind of miss this whole thing about what's going on now in the whole
We did, she
tech
did.
environment.
I did
And
too,
I
Kurt.
read
Did you?
this and it's
Okay.
like 19 billion for something I've never even heard of, and probably designed by a couple of guys in their 20s who are now set for the next 37 generations. I just don't get it. 19 billion for what?
Well, and you have to
No,
put it
for
in perspective.
WhatsApp.
Exactly. I mean, they in the article they talk about how Comcast wants to buy Time Warner Cable. Everyone knows those names.
Yeah.
For $45 billion.
Yeah.
So that is the playing field they're in, and I don't get it either. I don't, and that's when.
I'm sorry, it's not worth it.
It's
It's stupid money. It just goes to show you that like a company like Facebook that has somehow amassed billions and billions of dollars of net worth or stock worth or whatever for whatever reason. In fact, I don't even use Facebook anymore because it's just annoying.
Yeah,
But,
exactly.
but they go and they spend 19 billion, which I guess if they're putting it back in the economy somehow, or if these
Yeah.
these kids who are now multi billionaires, 19 times over get to.
No, but the rich get richer, the poor get poorer.
Yeah,
and I
I
got
don't
some
know.
Dutch
That's-
tulip bulbs I want to sell.
Hopefully, it comes back into the community in the form of philanthropy, which a lot of them do. So I guess that part is the good part. But it's just, when these guys hit home runs, these aren't home runs. These are hitting them outside of the Earth's gravitational pull.
Yeah.
This is just ridiculous.
We got
you
to come
also
up.
look-
Three of us can come up with some
Look
kind
at some of
of
the
app.
profits. I think Twitter hasn't generated a profit
Yeah.
since it's gone public or even before it. And I'm not sure about Facebook.
Well, do
but
you
these-
remember Netscape? Wasn't that one of the
Yes,
first ones? I mean, that
yes.
didn't generate a profit at all for.
Right, but Mark Andreessen is filthy rich, multiple
Yeah.
billion times over for creating something that ended up doesn't even exist anymore.
Yeah, and even Amazon, I think, didn't for quite a while. And then I think eventually.
I know. I think it's
I think-
maybe has. That one I think
finally,
it looks
finally
like it's. Well, it actually has a service, a product, whereas just
Yeah.
Facebook and WhatsApp and Twitter, I'm like, I just
They're just
don't
annoying.
get it. Exactly, and I think at some point in time, and the kids in this generation, the ones who are really into the Twitter is,
Yeah.
they're moving on to the next thing.
Oh yeah,
They're on
exactly.
Instagram now,
Yeah,
and
yep,
anyone
and
been to-
Pinterest or something like that.
Something.
Yeah, you know what? Eventually, Facebook will charge you to make sure that you don't get it on your computer. That'll
I
be-
actually think Facebook will be gone in 5 years.
Yeah,
I don't
I
think
do
any of us
too.
are going to be talking about it, and
that's where I think
and a
we're
lot
gonna
of people are
go.
going to lose money as a result from
Yeah.
the stock and from other investments and related
So,
investments.
audience, put this on your calendar that Mark Hanf said in 5 years he doesn't think that anyone will even talk about Facebook that much because they'll be out of business.
Well, think about MySpace.
Yeah.
I mean, is it still around?
I
But
don't
that's
think so.
whether we're having a bubble, is this kind of this new wave of these applications and these websites that are where their revenue is significantly driven by advertisement. It's gonna come to a point where it is just too much. And I don't know if it's just because we have to adjust to the new day and age where before you had the advertisements in your magazines and in
Yeah.
newspapers, is this just what it is? Or is it just been a huge push and it's gonna turn the other way at some point? Because a lot of people, I will not go on Facebook anymore. I actually never joined just because out of laziness.
Yeah.
And now I won't do it because it's just, I don't want any of the advertisement. I want some privacy.
But you mean you don't want to put that in your resume that, hey, I'm on Facebook?
Yeah, exactly.
Well, and here it says in this little article, WhatsApp has more than 450 million active users. Now, I'm going to argue with the term active because just because you sign up doesn't mean you're active.
I haven't used it for 6 months,
Right.
but I haven't.
So
on my
I would,
phone,
I
so
would,
yeah.
I would question that. And again, it's Facebook's money, and they can do what they want and buy
I
the
don't know.
companies
I've
they
got
want.
100 likes. That's pretty good. Huh?
I'm just blown away by the types of valuations and the money that these guys throw around.
Okay, some interesting facts about games in pubs in the UK. Now, in Glasgow, they banned all pub games from the city's 1,100 bars in 1939 because games encouraged drinking. And
And their sales dropped.
yeah, very much so. Their median one did too.
Yes.
And a pub in Durham had to cancel a mouse race because it was found that 15 of the 18 mice were pregnant and the other 3 were too tired to run at all, probably due to the warm beer that they serve. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions, and hopefully they won't be about right triangles again. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
Yeehaw!
That was fun.